how do I feel about people paying off their mortgage? I'm not against that at all. I know some people will go through our process and feel like, well, gosh, I should just never pay off my house. And that's not the case. I'd say, this is my 20th year of this business, and what I've learned is just some real money lessons over my time and through studying this. And really what's happening is people are just doing it out of order. So too often, the mistakes happen, the breakdowns happen when people are prepaying their mortgage and they don't have everything else in alignment with that. So one of the things we teach every client is this 4-step cash flow priority model. And the first step of financial safety, because everything needs to start with safety, is cash reserves. Establish some cash reserve. That's what's going to get you through the tough times. And so every client, we want them to come up with a goal. Is it a few $1,000s? Is it 6 months of your expenses? Is it 6 months of your income? Is it a year? And just come up with a goal and work towards that. That's the first bucket, so to speak, that they should be putting their money into. And that's, I call that sometimes that bucket of money is your sleep well at night account. I don't care about rate of return. I care about liquidity and safety with that money. Okay, but that's the first one. So what we're trying to do is establish a track for homeowners to run on and have that clarity and that confidence with their money that relates to their mortgage and how they finance real estate, borrow and repay. The second is getting rid of paying off all their consumer debt. Student loans, once they're out of school, do them no good. Credit cards, auto loans, every time they turn on that car, the thing goes down in value. So ultimately, the only debt I want our homeowners to have is debt that is leveraging an asset that goes up over time. And for most people that aren't owning their own business per se, that's a house, okay? Knock on wood. That is their real estate that they own. They're using a mortgage to leverage it. They might be borrowing $200,000 to own a $500,000 asset. All right, and I won't get into that for this question. But first is cash reserve, establishing that as a foundational piece for safety and peace of mind and sleeping good at night. Second is now chipping away, figuring out how to get rid of all your consumer debt, all your bad debt, as we sometimes call it, so that all you have left in life is a mortgage. That's it. And that's good debt. Whether you're deducting the interest or not, it's debt that's leveraging an asset that goes up over time. The third step that we teach is building your liquidity. Now, this is where magic can happen, but I don't see enough of it happening across the country as a society. I see people with some reserves in their bank, their checking, savings account, money markets. I see money going into their retirement accounts, hopefully, okay, at work or an IRA that they've got with a financial planner. Got some equity in their house, hopefully over here, but nothing in between their liquid savings accounts or checking accounts and their retirement. There's just nothing in between. That could be college savings down to cash for my vacation next year to Greece, whatever it is. There's just not any liquidity there. And that's the third step. We want them to now build liquidity. What is that? We'll have fun with it and say, you know what? 1 year of your income. If you're making $100,000 a year, let's set a goal to build $100,000 of non-retirement money. Okay? You got your cash reserves in place. Now we're paying off all your debt. And once that's gone, all that extra money, let's build that liquidity. Stocks, bonds, mutual funds. We'll get you in touch with a financial planner if you don't have one, or we'll engage your financial advisor who hasn't had much to do for you since you haven't had much liquidity. And step 4 of this whole priority model is pay off your house. Absolutely, we teach them to pay off their house. But do it in order. That's the key with this whole thing that I've discovered through my own life experiences and my research and reading lots of financial books and money books on money and life and all this. Do it in order, because here's the thing. Prepaying your mortgage without those other ducks in a row doesn't help you, because what happens is they're paying an extra, $250 a month to their bank. We won't name any banks. And then 5 years later, they go to sell their house. And they just get those same exact dollars back out. They just took money from a checking account month after month. moved it over to this other asset called home equity. And they think they're saving interest, but they're also losing out on opportunity cost. What would that money have made them over in the market somewhere, okay, over time? But forgetting about rates of return, now they're selling their house 4 or 5 years later. The kids are out of college or out of high school and heading off to college. They're just getting those same exact dollars back. This is conceptually. And they're worth less, if you understand inflation. Those same dollars are now worth less. And they do that over and over and over through 4 or 5 houses and owning real estate for 40, 50 years of their life. They just keep doing that over and over. And if you can step back and look at it from that 30,000-foot view, it doesn't make sense, right? Now, if you've got plenty of reserves set aside, no consumer debt, tons of money going into other investments outside of retirement, you get tons of liquidity for, your cousin calls you up and wants to go in on a house in Central Oregon, you got a business opportunity you can take advantage of, or bad times, and all that's working well, then by golly, go ahead, pay off the house. But I would recommend it's the house that you've decided you're going to stay in for retirement. Don't prepay a mortgage on a house that you're not going to stay in long term or keep as an investment property. Then you never really realize those gains, is the way I look at that. So that's how I approach it. There's nothing wrong with having a house paid off and no mortgage. I don't go that far on that side. The problem is people are doing it out of order, or they're paying off the wrong house because it's not the permanent house that they want to be in someday with no mortgage. They just don't know what else to do with their money every month. So that's how I'd answer that. Absolutely not a problem paying down your mortgage. Just do it within a plan and in the right order and on the right house.